Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. Greetings and welcome, Brad. It's fantastic to have you back on the podcast show.
Well, thanks for having me back.
Last time we spoke, it was the summer of last year, and that was obviously before Trump came into office. Now that he's come into office, we've had a number of months, although it feels longer, where he's had a chance to put his policies into action. What are your thoughts on his set of policies so far? Were there any surprises, or has it, in terms of what he's done, it's been in line with what you were expecting?
Well, look, I did not think he would move as quickly and as forcefully to put in place tariffs. I thought there would be a more, what to me, my mind would be a more orderly rollout of the different tariffs. And excuse me. You can edit stuff out, I hope.
Yeah, we can edit that. Yeah, of course.
Sorry, I have allergies these days. So I thought there'd be a little bit more of an orderly rollout of the tariffs. They'd actually start with the more conventional trade tools, start with the Section 301 case against China, start with sectoral 232 national security cases. You know, the auto case was sort of predictable. I thought some other sectors would be covered, but I didn't think that the administration would really use the International Emergency Economic Powers Act, the sanctioning authority of the U.S. government, as the core authority for most of its tariffs. And I thought it would take a little bit longer before we got to something that looked like a 10% across the board tariff. And if you're not using IEEPA, the International Emergency Economic Powers Act, you cannot just threaten to change the tariffs as readily, as rapidly, escalate quite as fast. You have to go through a process. You have to have a lot more documentation. So I thought this administration ramped up their tariffs very quickly. The magnitude is, I think, in line broadly with my expectations. I expected significant tariffs. But the administration is not done. So it is quite possible that by September, we have bigger tariffs than I expected. Right now, the tariffs that have been introduced are to the first order of approximation 3 times bigger than the China tariffs in the first term. So they are already quite significant. Tax policy kind of more or less as expected, I would say.
Okay. And so if we come back to tariffs, a couple of questions, come up. One has been that why hasn't it impacted the economy more, or is it impacting the economy and we're not really realizing it? And a related point then is why are stocks at their highs as well?
I'm not going to answer the stock market question. I don't know anything about stocks, and I'm as puzzled by anyone. It feels like the stock market has a mind of its own. To my mind, it's frothy.
Okay, understood. So back to the economy then.
Yeah, I think tariffs play out with a lag is the simplest answer. And those lags were maybe a little longer than some people expected. What doesn't seem to have happened is that companies did not seem to increase their prices proactively in anticipation of tariffs. In part because there's a certain probability some tariffs will come down, be negotiated away. And then as tariffs have worked their way through the supply chain, as they have worked their way through inventory. I remember a lot of the goods sold in the second quarter were imported in the first quarter ahead of the tariffs. And in some sectors like pharmaceuticals, enormous stockpiles were built up. I think you are starting to see some price increases. And I think in general, tariffs of this magnitude, call it 1.25% of GDP ballpark and just pay it costs. A little hard to estimate actually, because they can come up, they come down. Some of them stack, some of them don't. The embedded steel in a steel can, the embedded aluminum in an aluminum can. All these are kind of a little bit difficult to kind of precisely track. But that magnitude of tariffs would probably be expected, particularly when it's being offset by an infusion of spending power from tax cuts. Not to be a huge drag on the economy, a modest drag on the economy. And I think that's the outcome that I still see playing out. I mean, Q1 was weak. It was weak largely because of the tariff front running, and you could argue it's a little bit of a inaccurate read. Q2 is not shaping up to be a enormously positive quarter when you look at the number of across a number of indicators. There may be a little bit of a unwind to some of the tariff front running in the second quarter. And I don't expect a particularly strong third quarter. So I think you will see the impact of the tariffs, not as a recession, but as a modest deceleration of growth. And you're clearly seeing that in government tax revenues, which are up.
And in terms of the bigger picture, some economists are talking about how this, the level of effective tariff rates are the highest in a century. This is disrupting the whole global order. I mean, do you put it in such stark terms in your mind?
I mean, look, there are different ways of defining the global order. If the global order is defined as a global economy where the US is the main source of demand and net demand, and East Asia is the main source of supply, we've not yet disrupted the global order. We're paying tariffs, but we're basically importing roughly as much from roughly the same places. For now. So in that sense, the reason why there hasn't been more disruption is because a 10% base tariff, which is generating the bulk of the revenue, doesn't distort trade in a huge way. And China is right now so competitive that even with 20 and 30% tariffs on top of the narrower 230 Section 301 tariffs that put 25% tariffs on some specific products. So the across the board tariff on China is either 20 or 30. Like, China is so competitive that it's still exporting a decent amount to us, and it can find, it can export parts and then do final assembly in Taiwan or Vietnam. There were Chinese firms that knew the tariffs were coming and that had already experienced tariffs either at 25% or 7.5%, that already had plans to get around the tariffs by going through essentially their neighbors and doing final assembly in their neighbors. So in that sense, the basic flow has been resilient. And the 10% tariff that's in place between the US and Europe hasn't yet meaningfully changed patterns of trade. So if you want to tell a story of resilience and not radical change, you can tell that story. If you want to tell the story that this is a fundamental change in the global trading order, you can also tell that story. The US has completely disregarded any of the global trade rules or global trade norms that the US has put in place over the past 50, 60, 70 years. The increase in tariffs, the 10% base tariff, is not consistent with our WTO commitments. Changing tariffs on Brazil overnight because the U.S. doesn't like a court proceeding against the former president, that was outside the scope of trade law until Trump asserted that he could do it under the International Emergency Economic Powers Act. Trade deals that Trump himself negotiated with Canada and Mexico have not been respected. The auto tariffs and the increase in the steel and aluminum tariffs on Canada and Mexico to 50%, both of those were explicitly precluded in the renegotiation of USMCA. The general use of the International Emergency Economic Powers Act as a catch-all, which is, under challenge by the court, and that's a serious challenge. There's a possibility that could be struck down. That is a radical use of the sanctions authority, which has concentrated the ability to raise and lower tariffs in the executive, when historically it has been shared between the executive and Congress and constrained by the WTO in our interpretation of what the WTO rules allowed and didn't allow. So in the sense of tearing everything up and starting anew, where every single tariff line is subject to change and negotiation, it has been a revolution. That has yet to radically transform the structure of the global economy, but it has the potential to.
And on that of restructuring the global order in the sense, in the first sense that you said of Asia supplies, US sort of demands, you've talked a lot about this in your writings and so on. It did seem like Trump earlier on, when he came into office after inauguration, was attacking China head on, very directly. And it did look like he was going to, be very aggressive with them, but he seemed to sort of backed off. Is that because there's a realization by the Trump administration that the US relies on China so much, so it's no point having a fight? Or is there still, do you think, this view that China needs to be contained in some way, walled off, and or delinked from the rest of the world?
Look, too soon to tell. What is clear is that there was a sequence of events at the beginning of the Trump second term that led tariffs on China to escalate to 145%. And that led China to roll out its most powerful retaliation options reasonably, including blocking its use of export controls to block the export of rare earths and permanent magnets, which the U.S. does need, when that didn't prove to be an important leverage point. But in a conventional analysis over time, a tariff at 50% should lead bilateral trade to fall to close to zero. A tariff of 145% is prohibitive, and it was clearly causing all sorts of problems at the border, in the sense that a bunch of companies that were looking to build up inventory ahead of holiday season, and typically do so over the summer. Someone who sells Christmas trees, artificial Christmas trees, will make orders at this time of year to build up inventory ahead of a sales season in November and December. They would have had to have put up 145% of the cost of bringing the good in before their markup, but 145% is a lot. Well before they knew if they could pass on that big of a price increase to their customers. And they also weren't certain that that tariff was going to stay on. So in certain products, trade was just going to come to a halt. And some companies that were using a few components could afford to pay this 145% at the border just to keep the production process going. But in other cases, they weren't also sure that they could pass on the cost. So I think the administration made the mistake of escalating too quickly and too far. And then it was, in a sense, forced to back off and reach a deal, which was more or less a unilateral rollback by the United States that China reciprocated, because China said most of our tariffs are just tariffs in response to your tariffs. So if you take your tariffs off, we'll take our tariffs off. Now, in theory, a 30% tariff, and there's a weirdness that the bulk of that is on because China hasn't been good about controlling fentanyl. So if there was a deal on fentanyl, the tariff on China would go down to 10, which would cause all sorts of problems if your base tariff for Vietnam is 20. But let's set that aside. The administration is talking about limits on embedded Chinese content, or what they call transshipment. Transshipment's already illegal, technically. So in order for that to make sense, it has to be something like embedded Chinese content, that you can't bring in a whole bunch of parts from China, put a few screws in, put it in a box, and call it a Vietnamese product and get tariffed at a lower rate than China. And those kinds of tariffs, if they're serious about them, would put more pressure on China to change. But I think there's a more general issue, which is that instead of focusing on China, after this initial escalation and de-escalation with China, the administration seems to have decided to raise tariffs on everyone else. And the more you raise tariffs on everyone else, the less significant the 20 to 30% tariff on China is. If everyone else is paying 20 and China is paying 30, the difference is only 10. Or if that comes down because there's a deal on fentanyl, the incentive to continue to rely on China in many sectors will still be there. So
that's a very good point, actually. Actually, not many people make that point.
I'm not convinced, actually, that this administration, because they so quickly moved from focusing on China and an over-escalation with China to a peace deal on China, which was essentially a unilateral de-escalation, and now they're escalating with everyone else. I'm not sure that we're going to end up in a world where there's a big difference between the tariff China faces and the tariffs others face.
No, we'll come back to the rest of the world. Just on China, if you look at the overall current account surplus as a share of GDP in China, it has come down, since the global
No, it's
financial
going
crisis.
up. It's okay. It came down to 2% of 2% of GDP. It is now going up. China just fudges the number so it doesn't look like it's going up as much as it's going up. But it actually went up a lot in 2024 and early part of 25, even in the Chinese data. So it's now back up to 3, heading to 4, or at least 3.5 in the Chinese data. If you just look at customs goods, the well-measured component. And yes, China does import some services, mostly travel, so you can adjust it down for that. China should have an income surplus. Just look at customs goods. The customs goods surplus is back up to 6% of GDP. It fell to 3, but its peak pre-global financial crisis was 7-8. So the notion that China's surplus has come down is, in my view, out of date and partially a function of deceptive Chinese data.
Okay, no, that's a fair point.
And China, there's a very specific inflection point because China changed how it computes its current account data in 2021 and 2022, in the middle of the pandemic, in a way that clearly lowered the reported current account surplus relative to the old methodology by at least a percentage point of GDP.
Can you elaborate on that? What was the change in methodology?
China used to use the customs data, the data we all see, the data where you can match China's exports with your imports to calculate its goods surplus in the balance of payments. You adjust by taking the cost of insurance and freight out of your imports and putting it into services. So typically, the goods surplus is a bit higher in the balance of payments than in your customs data. So it is a very mechanical, simple adjustment.
Okay.
There was a change to using something that was designed to capture the transfer of value and contract manufacturing, where companies were producing in China for sale outside of China, and there may not have been a transfer of value of all the value of imported parts and exported to actually a Chinese resident. And so therefore, instead of using customs data in the update of the IMF's balance of payments statistics manual, they say you should use an internal survey or internal payments data, which China started doing. Now, I think that was a mistake, because that's unverifiable data, and any survey-based data coming out of China is suspect, and it's, you just can't check it against counterparties. And the result of that was that, as opposed to lowering imports in the in the transformation between customs and balance of payments, China raised them, and it lowered exports. And so this became a shift relative to the old methodology of between 1 and 1.5% of GDP. China says they're just living up to the IMF's new standard, but China cannot identify with credibility any specific area where there's a big gap between the new payment-based methodology and the old customs-based methodology. They said that in the customs data, Hanhai, which makes phones for Apple, was declaring too high a price, declaring Apple's global wholesale price. Okay, possible. They weren't getting paid that, so transfer of value should be the amount they are paid for the phone. But when you looked at the customs data, they were getting $400 a phone, which is a very reasonable estimate of the production cost of a phone. So it didn't actually check out. And to my mind, China has never demonstrated conclusively that this new principle should lead to such a substantial reduction in their goods surplus. But the key point is there's a series break. And any number after 2021, in my view, should be adjusted up by 1 to 1.5% of GDP. And China's economy has become much bigger than it was before the global financial crisis. So if you think of what China was doing before the global financial crisis, that was the surplus came because China's exports of manufacturers rose to about a percentage point of world GDP. China then imports commodities, didn't import so much services. At the time, China has so many reserves, is actually getting a positive balance on the interest income of its reserves. So its overall surplus is bigger than its goods surplus. Today, the manufacturing surplus is 2% of world GDP, with most of the change coming in between 1919 and 2024. So to my mind, yes, China's surplus came down after the global financial crisis, but that has fully reversed. and the world is adjusting to an expansion of China's current account surplus correctly measured, an enormous increase in its customs surplus, including its commodity imports, and an even bigger increase in its manufacturing exports, which are now the manufacturing surplus is now bigger by a meaningful amount than the biggest manufacturing surplus that Germany and Japan combined have ever run. Over the post-war history. So this is just a honking big manufacturing surplus. In any case, I don't accept the premise that China's current account surplus has come down and stayed down. It came down and it's now shooting back up.
That point well taken and well argued there. On the transshipment point, what are the main sources of transshipment of Chinese goods? Like how do they get around U.S. tariffs?
Look, I don't love the term transshipment
Okay.
because, as I mentioned, it's illegal. You cannot take a Chinese good out of a box that says made in China, put it in a box that says made in Vietnam, and tell the U.S. Customs Service this is a good from Vietnam. Now that does happen, but you're not supposed to do that. That already is a customs violation. Of course, that does happen, and generally happens through Southeast Asia. What is much more prevalent is you export the components of a good. An easy example, which we all know about, is that there are a lot of solar panels because of a big tariff on imported solar panels from China. There are a lot of solar panels that the U.S. imports from Southeast Asia, Vietnam, Thailand, Malaysia. Those solar panels use polysilicon, which is the underlying basis for a solar wafer, and a solar wafers, and that are assembled into cells that all come from China. And so the solar cells are just wired together and put in a panel in Southeast Asia. But the key the actual cell that collects solar energy, the wire, the mounts, all that is imported from China. So that is technically, that is not transshipment. That is doing final assembly outside of China. And if you take parts and do final assembly outside of China, that is a substantive transformation. And that is under conventional WTO trade law, that is a Malaysian product subject to the Malaysian tariff. So there's a lot of electronic components that go to Southeast Asia and Taiwan. Taiwan's not mentioned, but Taiwan's a big source of this rerouting around the tariffs with final assembly for the U.S. market taking place outside China. So for more expensive computers, you're going to do a little bit of final assembly in Taiwan, even though Taiwan's a little more expensive. For a lot of consumer goods, Southeast Asia, a little bit India, but Mexico tends to get identified. Mexico's not as, in my view, not as big. China's selling a lot of cars to Mexico. Those cars aren't being on-sold to the U.S. market. China's selling a lot of cars to Mexico, and we're importing a lot of cars from Mexico. So there's more of it's a displacement, or Mexico has been able to offset what would have been the disruption by the cheap Chinese auto imports, which would have reduced Mexican production by selling more to the U.S. I don't think Mexico has been as big a source of this sort of simple rerouting, doing final assembly in Southeast Asia trade as, China's neighbors.
And, from a policy perspective, what would you say if you were running the US administration, if you did want to cause a rebalancing of China, what would you say would be the best set of policies to deploy?
Look, China has to change some of its domestic policies. China has to be much more willing than it has been to provide direct income support, something like our earned income tax credit, where the government sends low-wage workers a check, something that increases spending power at the low end of the working population. Also needs to tax less. It taxes low-wage work quite heavily because there's a big lump sum initial contribution into China's social security system, which is a hefty burden on workers who get a relatively low salary. So the burden on Chinese workers as a share of their income is actually almost as high if you're at the 25th percentile as if you're at the 90th percentile. So it's a very, very, very regressive tax system that relies a lot on consumption taxes. change that. Don't take as much money away from low-income workers. Give money back to low-income workers. Get more money from your high-income workers who don't naturally save as much and redistribute. And then centralize some of the provision of social insurance. All these things are fundamentally needed to expand Chinese consumption and expand Chinese demand. So China doesn't have to rely on exports and investment as much. So that's, if I were in charge, how do you get China to change these very fundamental things? You have to be willing to use some leverage. You have to sort of credibly threaten. I think Trump probably more than most could have, that we're not willing to solve your domestic problem by taking all of your spare capacity and all your excess capacity and just letting you sell it to us. Now, it would help if Trump had been able to build a coalition that included at least Europe and maybe some others who made the same argument. We are no longer willing to absorb the spare capacity, the excess capacity that you have built because you have refused to take other means to stimulate your economy. Because you don't provide household support. You just have thrown bank credit and subsidies at overbuilding EV and battery and you name it, factories where each one has subsidized by a local government. And now you have so much capacity, you're trying to essentially let the rest of the world solve your internal solution. You can just say, no, we're not willing to do that. Trump hasn't built that coalition, but that'd be what I would do. I'd be building that coalition. Trying to hard, but I think Europe has evolved. I mean, Europe's really been hit hard by the second China shock. And then I would be putting a lot of pressure on China to let their currency appreciate. China's super cheap. And China's real effective exchange rate, once you adjust for inflation differentials and weight the trade by the exchange rates of all your trading partners, not just looking at the US, it's down 20% over the last 3 years. That's a big move. That's pushing record levels of exports out of China when you adjust for prices. Net exports last year contributed 2 percentage points to China's growth. That's a lot. If you're only growing it, officially by 5, probably in reality by more like 3 to 4, you're getting, in my view, officially you're getting close to the majority of your growth from exports. I would say you're actually getting the majority of your growth from exports. That level of relying on the rest of the world for a big economy tends to generate a reaction, and it tends not to be sustainable. And I think it's now putting pressure on China's currency, which we should exploit, push China to let its currency go up, or even engineer an appreciation of its currency. So those to me are kind of the core things. Obviously, we are a little bit a source of the excess demand in the global economy with our 6 to 7% of GDP fiscal deficit. And it would have been good, and it still would be a good idea if we had a sensible plan, not a plan where you sort of shoot individual agencies, including individual agencies that play an important role in saving people's lives, but a coherent plan for bringing our fiscal deficit down, which we don't. So the other big component of global rebalancing of lower trade deficits is a smaller U.S. fiscal deficit. I think some industrial policies in the U.S., some of the things that Biden started are basically good and necessary to kind of jumpstart U.S. industries. The CHIPS Act was yielding results. I think we should have kept in place more support for EVs and batteries to kind of catch up with China. And then I think we should recognize that China's eaten a bunch of Europe's surplus. Europe has a pretty high reported surplus, but a lot of that is now pharmaceuticals made by American companies in Ireland for export to the U.S., so I don't think that's real. But otherwise, the auto sector in Europe is hurting because of Chinese competition. And I think Europe is actually taking the steps to make sure that it can grow a little bit more effectively on its own demand. Some of that's rearmament in the face of the Russian threat, clear Russian threat. Some of this, Germany's just correctly decided that it needs to invest more in its public infrastructure and not be as fiscally frugal, which will support rebalancing. So I think Europe is actually making decent progress. And thus, I am quite critical of the Trump administration's apparent desire to launch a pretty serious trade war with Europe by making to what I would view as fairly unreasonable demands in the current trade negotiation.
In terms of the US-European trade negotiations, the Europeans have talked about all sorts of retaliatory measures. I mean, they've kind of upped the ante in terms of what they're willing to do. I mean, how do you see this playing out to the extent that one can kind of game this out?
Look, there's still time to reach a deal. I think, latest one can infer is that if the Europe, and I don't think Europe will accept this, but if Europe accepted a 20% base tariff, the same tariff that Vietnam accepted, and accepted 25% tariffs on autos and 50% tariffs on steel, and who knows what tariff on pharmaceutical, and made a bunch of additional concessions that address U.S. concerns in traditional areas of concern like agriculture and like digital trade, then the U.S. would agree not to go to 30%. I mean, that's kind of the U.S. offer. The Europeans are saying, no. You've gone from 0 to 20. That is unfair, unjustified, unwarranted. The sectoral tariffs are also, in many cases, in the Europeans' view, unwarranted. They don't think that they are a national security threat in steel, or that their luxury auto exports are a national security threat to the U.S. They want some kind of negotiated outcome where they get some access to the U.S. market at a 10% quota, like what the U.K. got. They don't generally think their digital regulations are unwarranted. They think they're part of a legitimate exercise of their regulatory sovereignty. They don't think digital services taxes are a restraint on trade. They think they're a reasonable way of raising revenue when American companies like Google and Facebook and their parents book all of their revenue in Ireland, and all their profit is paid in Ireland or the US, and the places where they operate and sell ads don't go to any tax revenue, and they've undermined the traditional media tax base. So the Europeans just don't generally believe that there are a lot of legitimate grounds for negotiation. They would have negotiated over their 10% auto tariff compared to our 2.5% auto tariff. They aren't willing to accept that we go from 2.5 to 27.5 and they stay at 10. That feels unfair to them. So we are just trying to figure out, between this U.S. demand and what the Europeans are willing to do, if there's any space for a deal, or whether Europe will use its multiple retaliation options. Europe has very clearly said that if there is a deal like that was offered to the UK, they don't retaliate on a 10% base tariff. They get some consideration to be determined on the key sectoral tariffs that are higher, 25 or more. They would take that deal. They are willing to accept a 10% tariff. We don't know if they're willing to accept a 15% tariff in a compromise. We don't know if that depends a bit on whether they get some kind of concessions on autos. All that's being negotiated, or maybe not negotiated. Maybe the people are just twiddling their thumbs so far apart that there isn't any room for a deal. And Europe is basically waiting to see if the U.S. goes ahead with the 30% threatened tariff on August 1st, and then it would launch its retaliation tools. You said, yeah, correctly, they're readying them. They have a retaliation list of 25, which is basically for the steel tariffs from Trump's first term, which weren't implemented during the Biden days because of a tariff rate quota deal that gave Europe tariff-free access to the U.S. market up to a certain level for steel. They need to do more than that. They have another tariff list, which would bring the total package up to about $100 billion, which is more in response to the various tariffs that Trump has already introduced. To my mind, if the U.S. does across the board, the right response is something that is also across the board, but with exclusions for LNG. And then the heavy artillery for the Europeans is the threat to use what's called the anti-coercion instrument, which would let them change regulations in a way that penalizes U.S. digital giants. So threatens the profit engines of the tech companies.
And you also mentioned the pharmaceutical, recycling of trade that goes back to the US. I mean, number one, I mean, how do the Europeans view that recycling that goes to Ireland? And secondly, if there are tariffs on pharmaceutical imports from Europe, does that not hurt US companies as well? I mean,
Yeah,
how does the administration view that?
well, I think the administration says the U.S. companies should be producing here, so get your act together. Look, there's no more incoherent, broad policy than the current policy of the Trump administration towards the U.S. pharmaceutical sector. They signed a tax bill that retains an enormous incentive for American companies to produce high-end, patent-protected pharmaceuticals outside of the United States. Produce it inside the United States, and pharma prices here are higher than anywhere else. We're the big profit engine for every pharmaceutical company globally, including our own. Produce your drugs here if they've been developed here, and the IP is here. You're going to pay a 21% tax rate. Produce those same things in Ireland and move the intellectual property to your Irish or to your Dutch or, I don't know, to your Belgian or to your Maltese subsidiaries, someplace that has a nice patent box for medicines, low tax rate for meds. You will pay, under the old tax system, a 10.5% tax rate, and under the new system, 14. Key thing is 14 is a third less than 21. The incentive to go outside the U.S. is still there. So the tax code favors Irish production for the U.S. market, to put it simply. The tariffs will try to undo that, and to some extent they will. A lot of these drugs, the actual production cost is 1/10 or whatever, maybe in some cases less, of the sales price. They're marked up to recoup the cost of research and development and to provide the profits for the companies, to encourage the companies to develop new drugs. Huge debate about whether they are overpaid or not for that incentive. But there is no real relation between production cost and sales cost. So the companies can, in theory, unbundle some of this and just treat their Irish manufacturing operations as a contract manufacturer. Put maybe the intellectual property in the U.S. or put the intellectual property somewhere else and just pay the actual cost of production and declare that at the customs border. And it's a complicated tax deal because right now, the border price bundles together the production costs, the IP, so forth and so on, to move all of the cost basis to Ireland and to reduce your reported U.S. profits. I mean, the typical big U.S. pharmaceutical company reports losing money in the United States, even though we have the highest drug prices in the world, account for the majority of their sales, and makes enormous profits offshore, almost always in Ireland or Singapore or Switzerland or Belgium. So, you have to figure out what you can do legally to change your tax arrangements. And that's complicated. But you can lower the base of your tariff by no longer charging this very inflated price to move the profit out and just import at the actual cost of production. So I think the tariffs will have a big impact on the reported numbers in the pharmaceutical sector. And over time, some of the incentive to produce abroad will go away. I mean, the incentive was the tax things. And if the tariff undoes the gains from the tax, much harder for generics where there is no profit margin. And there's not, in some cases, a lot of capacity, I would say, to make low-end generics in the U.S. anymore. So you have to build up factories competing against China. It only works if you're confident a high tariff will stay in place for a long period of time, which basically means the cost of some generic medicines would go up.
And actually, on that point, I mean, what do you make of the idea of reindustrializing the U.S.? I mean,
I'm in favor of it.
And policy-wise, do you think that tariffs or other policies that Trump has implemented will support that, or will it slow it down, or which at the margin, which is a net positive or net negative?
I think right now at the margin it's net negative because we're kind of doing tariffs willy-nilly. If you want to reindustrialize the United States, you don't tariff Brazil. Brazil is actually a good market for our manufacturers. We import commodities and then some of regional jets, which have a lot of U.S. content from Brazil. But we are net export manufacturers to Brazil. You shouldn't be fighting a trade war with Brazil if you want to reindustrialize. Same with Canada. We import commodities from Canada. Oil, most obviously. Take out oil, we run a trade surplus with Canada. We run a trade surplus in manufacturers with Canada. We do import a lot of aluminum from Canada, but we should import aluminum from Canada. They're a low-cost producer. They've got a lot of hydropower that is efficiently used to produce aluminum, has been used to produce aluminum for the U.S. market since World War II. All the bombers that helped us win the war, a lot of them use Canadian aluminum. We're allies, we're friends, we're neighbors, we're integrated. That aluminum becomes the basis for our own industry. And then we're putting tariffs on a lot of imported parts that make our exports more expensive. Now, what I do think has the potential to be helpful are tariffs in specific sectors. Without a tariff on EVs and without some restrictions on normal Chinese auto exports, our auto industry would disappear. We just buy cars from China. China has an insane, China can produce twice as many cars or more than it can sell at home. It can produce at least 50 million cars. Its domestic market is 25. Our market is 16. So China could, in theory, supply all of our market. And a lot of that capacity in China is pretty good capacity. It's the old GM, the old Ford, the old VW, the old Toyota joint ventures. So an enormous amount of our auto demand could be supplied from China. So I think there is a case for targeted tariffs. I do not object to a world where you try to build a tariff wall around China to penalize China for basically throwing money at manufacturers and starving its consumer sector so that it has no choice but to export. I think China's economy is very unbalanced and a problem for the world. But a lot of the other tariffs make it much harder to industrialize, and they don't serve much positive role. They don't help us create a stronger production base, and they don't expand the market available for U.S. Goods, because we're raising prices on stuff we're going to import anyway, and therefore have less money to spend on some of these other goods. So the overall package to me does not seem coherent if your goal is to reindustrialize. What I think would work is getting rid of these tax incentives that penalize investment in America. Why does our tax system reward an American company if it puts a factory in Ireland rather than South Carolina or North Carolina? It just
Actually, on that point, I mean, was that debated in the recent bill or not? I mean, is there an awareness amongst Congress people that
there was legislation, unfortunately supported by 4 Democratic senators, that would have ruled this out. You wouldn't get the low tax rate for so-called round tripping if you're producing abroad for sale back to the U.S. So in that sense, yes, senators are aware. Certainly Democratic senators are aware. It didn't get any traction with Republicans. I don't know why. To me, this should be bipartisan. It does require admitting that there was a problem with the Tax Cuts and Jobs Act, that the structure of the Tax Cuts and Jobs Act created an incentive to offshore. A lot of people still think this 14%, previously 10.5% tax, minimum tax, is a penalty on companies that move abroad. You don't get zero. No, it actually works as a reward for companies who move abroad, because they're moving out of the 21% U.S. tax rate into this lower 14% tax rate. So there is not a complete understanding. The pharmaceutical lobby is very powerful, and no Republican joined with these 4 Democrats, who include, Senator Wyden, the ranking member on the Finance Committee. So there's awareness amongst the Democrats, not amongst the Republicans, not a willingness to change the structure of the Tax Cuts and Jobs Act. So in that sense, close but no cigar. The majority continues to reward American multinational companies who don't produce in America. And it should be an outrage. I am outraged. I mean, obviously outraged. I'm beyond irate. And when I'm not on my better behavior, I am known to be a bit Trumpian, let's say, in my language around this issue. So one thing is just get rid of a perverse incentive, and it impacts pharmaceuticals. It also impacts quite clearly applied materials and Lam laboratories, 2 companies that make the equipment to make semiconductors, who report earning all of their profits in Singapore and Malaysia, respectively. So they've clearly adopted a produce abroad to move your profit abroad and only pay the low tax rate, the lower global tax rate model. We should want them to be producing here. Secondly, we need to, the CHIPS Act was working. We need to recognize that in some sectors, you need to provide tax incentives to get manufacturing up and going. It's unfortunate, but in some sectors where we lag, getting the initial investment is a necessary precondition to have a market that can be shaped by the tariffs so that companies can be competitive. Plus, in sectors like semiconductors, which are an input into most other goods, standard economic theory says that if you tariff it, you basically penalize your electronics industry. Everyone has to pay a higher price for your imported semiconductors. That gets passed on. Others can make the same electronics without paying the tariff costs abroad. They don't have to pay if you're getting the chip from Taiwan and we have to pay 25% of the value of the chip for electronics for the US market and someone else doesn't, unless you tariff the entire stack, the incentive is not helpful to have that tariff. Now, you can put embedded semiconductor tariffs on. That's probably the direction they're going. But the classic solution when there's an input that is very critical, like semiconductors, where you want your industry, you tend to rely on subsidies and on tax incentives, which basically give companies a huge break on capital investment. They still have to produce the goods efficiently, but they don't have to pay the full cost of capital investment. Now, the new tax bill does have full expensing, which is a less generous version of this for the entire economy. But I think you do need some sector-specific incentives like the CHIPS Act. I do think we need to support our battery industry. I think batteries are national security critical. They are needed for drones. They're not just an EV thing. And the Trump administration is tearing up parts of the industrial policies that the Biden administration adopted. And then finally, hey, the dollar is too strong. The dollar's still it's off the super strong dollar at the beginning of the year when the Trump trade was tariffs will push the dollar up. That didn't work out. But we're still at very levels that are very high relative to history. 150 for the yen, close now back to 1400 on the won, 30 on the Taiwan dollar, 715 on the Chinese yuan. These are very, very, very weak levels for key Asian currencies. If you want to adjust, Asian currencies have to appreciate relative to the dollar. Currency adjustment is the technique that we know works. And what it does is it raises the cost of all goods coming out of China, not just goods that come directly to the US. And therefore, you don't have to worry about complex rules of origin that penalize embedded Chinese content and are hard to enforce.
And how would the administration orchestrate that?
Well, the easiest way is you are willing to trade lower tariffs for a commitment by certain countries to let their currencies appreciate. Now, for Taiwan, that's super easy. Taiwan, and I think China now, but I'm out of consensus on China, but Taiwan, everyone knows, is in the market blocking appreciation of their currency. So if they stop intervening, the currency goes up 27, 25, who knows? We don't know because Taiwan has never, in its recent history, ever let its currency float up unconstrained. So that all you have to do is convince the other country to stop intervening. And for Taiwan, that would have to be some deal on the tariffs. Same thing with China. For a break on the tariffs, you let your currency go back up. China, I think, is now holding its currency down. Not that hard. And then China's currency has...
And China, the way they're doing it is not through official intervention, but it's through banks, is it? Or
it's through the state banks, combined with the guidance from the central bank, which sets the fix. Yeah. And then, the central bank could still be active in the market. Could still be, it could be doing forward contracts with the state banks. So it ends up accumulating with a lag some of the FX that is initially bought by the state banks, and then it can hand that FX back out into the economy so it doesn't show up on its balance sheet. It does things called entrusted loans, where it basically gives money for a fee to the banking system to finance activities that China's state wants to support. A lot of the policy lending by the China Development Bank and China XM have been supported through this mechanism. So China has ways of actually intervening and even using the central bank's balance sheet where it doesn't show up permanently on the central bank's balance sheet. But the bulk of the activity now is coming through the state commercial banks. We had 40 billion in net increase in the assets of the state commercial banks in June. There's an indicator that combines the state banks and the PBOC that was plus 25 in June, just out. It's not 100 billion a month, but in some months we're getting close to 50, depending on the indicator. That's a lot of it. Things have changed. There's pressure on China to appreciate, given where the capital controls are and given how big their surplus is. It's still growing, by the way. China's surplus is still getting bigger. And given that their currency is down 20%. For a country like Japan, it's a little more complex. They're not intervening right now to hold their currency down. The Bank of Japan has been a little slow to raise rates. Inflation is now actually 3-ish in Japan. They haven't raised policy rates very significantly. They're still well under 1. If you got rid of the tariff uncertainty, maybe the Bank of Japan would move. But then more directly, Japan could ask its big government pension fund to hedge, which effectively is increasing demand for dollars and for yen, and it should bid up the yen. They have dollars, they need to hedge it back to yen, so it's demand for yen. The Ministry of Finance could commit to selling its now considerable interest income on its foreign exchange reserves back into yen, which would be help reduce Japan's budget deficit and also be a bit of support for the yen. So I think Japan could help engineer in the way that at certain points in the past, the Japanese acted in a pretty coordinated way to bring the yen down. I think they could engineer a bit of a coordinated approach to pushing the yen up. The weak yen has become a bit of a problem in Japan. It's reduced purchasing power, made the electorate a bit unhappy. So I think there's a basis for making that. And obviously, Japan want relief on the auto tariffs in return. And Secretary Bessent's a currency trader. He knows how to do intervention. We could do a bit of joint intervention to help Japan out. And I think that's broadly the approach around Korea.
I mean, I was going to just say, I mean, this type of policy, it sounds like it makes a lot of sense, but is there much talk about this as a possibility or not?
Well, let's say that there is a reason why I'm not in the administration. There are many reasons why I'm not in the administration. Probably there's less talk about this than there would be if I were in a position to be the architect of American currency policy. But the reality is we don't know. Like, the Treasury has made it clear that it doesn't want currency issues to be part of the broader negotiations. They will be handled more directly, more carefully. Fair enough. I agree that these kinds of negotiations are delicate. And since they are being held, to the extent that they are happening very privately and very quietly. There's not a lot of discussion about them in the press. That could be because there's actually not a lot of discussion about them, period. We just don't know. We won't know until there are deals with the key countries, Korea and Japan. They're behind the queue vis-a-vis Europe, because the basis for any of this for Korea or for Japan will be a commitment by the U.S. not to do the 25% auto tariff, to bring it down to 10. And Trump hasn't been willing to signal that's the deal he's willing to do. And then with Taiwan is not currently at the front of the negotiations. With Taiwan, you can't avoid the currency issue because Taiwan is now intervening on a scale where in the October Treasury Foreign Exchange Report, they will be designated as a currency manipulator. So you will have to deal with this in Taiwan. With the others, it's a choice. And I just don't know where the negotiations are, or even if they've happened.
Okay, great. Well, we've covered a huge amount of ground, and I don't want to take up too much of your time. Now, just for our listeners, what's the best way for people to follow you?
Well, for now, I'm still on X, pretty active. I have a blog, Follow the Money, on the Council on Foreign Relations website. And then if you go to my bio page on the Council on Foreign Relations webpage, there's a tab which has my recent published articles, no matter where they appear.
Okay, great. Okay, so I'll include that in the show notes. But with that, thanks a lot for incredibly expansive and detailed, conversation about trade and tariffs and so on. And keep up the good work.
No, thank you. Thanks for having me on your show.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.